Is Peter Schiff now predicting deflation? I think the short answer is yes. And I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over the reverse wealth effect that Peter has been talking about a lot lately on his podcast. And he really took a deep dive into how this would work in his most recent episode. More on that in just a moment. But let's go to this chart of the NASDAQ. This goes back to May 2017 all the way to today's date. And just a forewarning, this chart from Yahoo Finance is very bizarre. The only 2 dates it had on it was May 17th and November 19th. I actually added this one. And for some reason on the left, it goes from 4,000 up to 8,000 up to 12,000 and then up to 18,000 or so. Who knows? But anyway, the chart gives us the data we need. So May 2017 starts off 6,100 roughly, the NASDAQ. And then we pretty much go up in a straight line to 9,700 in November of 2019. Actually, I'm sorry, this 9,700 mark was just before the cerveza sickness, so the beginning of 2020. I wanted to show that the NASDAQ plummeted by almost 3,000 points from, call it, February to maybe April of 2020. But then the Fed came in with QE infinity, or at least 120 billion a month is what they kind of settled on. And then they backstopped the corporate bond market. And I think even more importantly, the federal government came out and started deficit spending like the drunken sailor they are. They came up with the CARES Act, and the deficit spending for 2020 was almost $5 trillion. This takes the NASDAQ screaming higher to about 15,800 in November of 2021. Now, I pointed out that this is a very key date. Why? Because this is when the Fed came out and said that they were going to start raising rates. What did the NASDAQ do from almost the day Jerome Powell uttered those words? Goes straight down to where it is today, around 12,500. So Peter uses the NASDAQ as an example of this reverse wealth effect. On the way up, it is true. People have more purchasing power. They feel richer, therefore they spend money, and this gives a boost to GDP. But the opposite is true when the market goes straight down, especially when it goes down this quickly. People feel poorer, they have less purchasing power, therefore they buy fewer goods and services, GDP goes down. And in his most recent podcast, Peter points out some startling statistics that this decline that we've seen over the last few months, first and foremost, is more than the decline in nominal terms that we saw during the cerveza sickness. And the last month in the NASDAQ has been the biggest 1-month decline since the GFC. To hear some of these statistics directly from Peter, editor, let's cut to the clip.
On the week, the NASDAQ was only down 3.9% due to those earlier gains, but for the month, it was down 7.3%. That is the worst month for the NASDAQ since November of 2008. Think about that. What was going on in November of 2008? That was the 2008 financial crisis. Lehman Brothers, Bear Stearns bankruptcies, the collapse of Fannie Mae and Freddie Mac, right? The greatest recession since the Great Depression was just beginning, and that's the last time the NASDAQ had a month this bad. But it actually gets worse because on the year, the NASDAQ is down 17% during those first 4 months. This is the worst first 4 months for any year in the history of the NASDAQ. The records only go back to 1971, but this is the worst start to a year, including 1971. So we had a brutal bear market during the stagflationary decade of the 1970s, yet we just had a first 4 months of the year that was worse than any 4 months going back to 1971. In fact, now the NASDAQ is down 23.4% from its high, moving deeper into official bear market territory. Of course, some of the biggest losers are the names that Americans own the most, the FANG stocks. I have been talking about FANG being defanged. I've been warning about these stocks, and one by one, they get taken out behind the barn and shot.
And then throughout the podcast, Peter goes back to this point that's very, very good. And he says that the NASDAQ comprises a large portion of most people's 401k, which of course represents a large portion of their overall purchasing power. So if the NASDAQ is completely plummeting, so is the average American's purchasing power in aggregate total. But if the purchasing power is going down because of this reverse wealth effect, we also have to remember that the CPI print is about 8.5%. And as all of you know watching this video, that dramatically understates the rate of inflation. And even with the 8.5% CPI, wages are lagging far behind. So in real terms, people's incomes and wages are going down. So if we have these higher prices, it decreases demand even further, which puts serious downward pressure on GDP. So let's take it one more step. This is a little chart I drew just as a visual. So the red line represents prices, black line demand. As prices go up, demand goes down, but at a certain point, demand goes down far enough to bring down prices as well. We've all heard the saying, the cure for high prices are high prices. Why? Well, number one, it brings more supply online. But number two, it decreases demand to a point where the prices can't continue to rise. They have to flatten out and even come down. This is why I would argue my good buddy Peter Schiff, at least in his last podcast, was actually arguing for deflation, not inflation. Step number 2, the Peter Schiff reaction video. So I've spoken to my good buddy Peter quite a few times. I don't want to put words in his mouth, but if he did a reaction video to my step number 1, I think this is what he would say. Let's start off by the supply side of the equation. He'd say, George, you're just focusing on the demand side. You've got to look at the supply side as well. And he'd say the United States is running these huge trade deficits. So insert everyone's favorite stick figure, Moody the millennial. So Moody is producing far less stuff than they were prior to the cerveza sickness because they have their gig at Starbucks or Uber, and that's not producing goods. Where does Starbucks get the stuff they sell? Well, that would be China or overseas. And to Peter's point, the trade deficit has been exploding recently. So if we are importing more stuff from China or overseas, that means we are exporting more dollars. Well, our CPI is running at, let's say, 8.5%, and there's a negative real yield when you look at the rate of the 10-year, which let's say is even 3%. So we've got negative real yields between the 10-year and the stated inflation number of, call it 5.5%. So Peter's point would be, why would the Chinese or anyone else hold a 10-year treasury or any dollar-denominated asset when you're losing purchasing power adjusted for the rate of inflation? And his point is they most likely won't. So when we send them all of those dollars for this stuff that Moody or any of us, Americans in aggregate total, aren't producing in the United States, instead of taking those dollars and keeping them on the balance sheet of the central bank or buying treasuries, they're most likely going to sell those dollars in exchange for some other currency, maybe the Chinese yuan. So that means that there's more dollars circulating in the global FX market and at a high rate of velocity, which means the dollar goes down in value against other foreign currencies. I think right now, Peter would argue the spike we're seeing in the DXY is only temporary. So if the dollar goes down, that means all this stuff that we're importing from overseas, the price goes up. And if the price goes up, regardless of how much demand is being destroyed in the United States, because we import so much of the items that you get at Walmart, Home Depot, and Target, the prices in aggregate total will still go higher, although demand is going lower. I think his next argument in the Peter Schiff reaction video would probably be, George, you're crazy. Right now, we have huge negative real rates. Fed funds is only at 25 basis points, for heaven's sakes, and the stated CPI is at 8.5%. We know that inflation is a lot higher. So we have 10, 12, 15% negative real interest rates. Jerome Powell is by no means Paul Volcker when he takes rates from 0 to 25 basis points. Or now he's really talking tough that he's going to raise rates 50 basis points all the way up to 0.75%. So in order to tame inflation, we would need positive real rates. The Fed would have to take rates above, let's say, 8.59% in order to bring the CPI back down, just like they did in the 1970s. And editor, I've got a note to myself to remind you to go ahead and throw up a chart of the early 1980s when Volcker took the Fed funds rate above the rate of inflation. In other words, we had positive real rates. And I think Peter's last pushback would be, yeah, we may have some short-term deflation. And I don't think he would argue we would have deflation. I think he would argue we will most likely have disinflation if the stock market were to collapse by, let's say, 50% and the housing market goes down by 20%. He'd say, sure, we might have some disinflation, meaning the CPI would go from 9% down to 7% or 6%. But we definitely won't get deflation where prices actually decrease, go to -2 or -3%. And this will only be short term. Why? Because the government, your drunk, insolvent Uncle Sam, will come in deficit spend like the drunken sailor they are, the same way they did in 2020. So instead of CARES Act 1.0 of $5 trillion, we'll get CARES Act 2.0 of $10 trillion, $15 trillion, maybe even $20 trillion in an effort to alleviate the pain and prop up the economy. And there isn't going to be any buyers for those bonds, so the Fed is going to come in and do QE infinity to try to basically monetize the debt. So your drunk, insolvent Uncle Sam spends all of these dollars that go to Moody to try to prop up the economy. And Jerome Powell comes in and says, okay, Sam, I'll go ahead and buy those treasuries from you. We'll make money printer go burr, and this will solve the problem. But Peter points out that although this may temporarily prop up the economy, it's going to stoke the fires of inflation even more. Step number 3, my reaction to Peter Schiff's reaction video that he didn't really do, but we're just pretending that he did. So like we said in step number 2, his arguments would most likely consist of kind of the supply side of the equation with the trade deficit, negative real rates, and then even if we did get some disinflation, it would only be short term due to deficit spending and the Fed monetizing the government deficit spending itself. So if I were to push back a little on my good buddy, I would say, yes, I totally understand what you're saying, but I also would add in the dollar-denominated debt globally. So let's go back to this scenario where Moody, the aggregate total of Americans in general, producing a lot less stuff, trade deficit goes up, we're exporting more dollars. I would say, yes, we are exporting more dollars, but there is so much dollar-denominated debt outside of the United States that those corporations would be taking those dollars and using them to pay down their existing debt. And if they're paying down their debt, what happens to the money supply overall? It actually decreases. as most of you know from watching my videos. So Peter would say that they're just going to sell those dollars back into the FX market. They're going to circulate more dollars in the global supply. Therefore, prices increase. So if the black line, dollars, red line, prices, the value of the dollar goes down, the prices go up. And that's what takes us back into the scenario where Peter would most likely say prices could continue to go up even if domestic demand is going down due to asset prices going down. Where I would say, I totally get it, but my base case would be more so that although there are additional dollars going out, it really wouldn't decrease the value of the dollar against other fiat currencies. Number one, because of the dollar denominated debt, but number two, because you're only measuring the dollar against other fiat currencies, and those governments are just as profligate as the United States. So it's kind of a race to the bottom. So I don't know that the prices for our imports will increase dramatically due to the dollar losing value against those foreign currencies in the next 6 months, year, 2 years. Next, let's move on to the negative real rates argument in the 1970s with Paul Volcker, and that you can't defeat deflation without positive real rates. Well, I would look at a chart of the 1940s that I've used in a lot of my videos recently that shows in 1947, the CPI went up to 19.5%. And where were interest rates? The long bond was pegged at 2.5%. So when you look at the relationship between the 30-year Treasury and the admitted CPI number of 19.5%, you have a negative real rate of 17%. But what did the CPI do over the next couple years? Did it explode even higher because negative rates were so extreme? No. It actually came back down to a point before 1950 where we had negative 3% deflation. Deflation where prices actually went down. So I'm not saying that the 2020s are exactly like the 1940s. I'm sure a lot of people in the comments will say, oh yeah, George, but in the 1940s, we had a supply shock, we had this, we had price controls, we had all these things that we don't have today. Well, I would argue that we might have a supply shock, and that may be one of the reasons why our CPI is so high. And I get it, we haven't had price controls yet, but I think we may have them in the future. But my whole point is to show it is possible for the rate of inflation to come down dramatically without positive real rates. And my last reaction to Peter Schiff's last reaction or last argument was he was, or would most likely say, I don't want to put words in his mouth, but most likely would say that even if we have some short-term disinflation due to the demand destruction we talked about in step number one, government would spend, Fed would monetize, and therefore there would be more dollars circulating in the US economy, and inflation rate goes up. So point being that this would only be short term, even if we did see some slight disinflation. And actually, I don't have a pushback here because I agree. This is pretty much my base case. As most of you know from watching my videos, I think in Q3, Q4 of this year, we could have some disinflation, meaning that the CPI goes from wherever it is at the time, say 9.5%, maybe 8.5%, down to 7, 6, maybe even 5. And this would be a result of the Fed raising rates to a point where something breaks, like the stock market, and this causes that demand destruction that we were referring to earlier. And therefore, prices come down or go up at a lower rate. And I would actually add a few things that could also increase the rate of inflation after we have this short-term disinflation. Number one would be going back to the supply side of the equation, not necessarily the trade deficit, but the supply of stuff, goods and services. I think the United States is moving more towards protectionism, and this move globally towards deglobalization, so producing more stuff in the United States. But unfortunately, I think the regulations are going to increase substantially, making it harder and harder to produce the stuff we need domestically in the United States. And if we do produce it here, the price will be much, much higher. Also, I think that the government is going to disincentivize work. We go back to this, the drunk, insolvent Uncle Sam giving Moody, the millennial, not only stimmy checks, but maybe even UBI, universal basic income, every single month. This makes Moody not really interested in driving Uber or going to their gig at Starbucks. So even if you do have demand decreasing, I think the supply could decrease at an even faster rate, putting upward pressure on prices. But the main takeaway is my good buddy Peter Schiff, at least in his most recent podcast episode, is inadvertently predicting, we'll call it short-term disinflation. For more content that'll help you build wealth and thrive in a world of out-of-control central banks, big governments, check out this playlist right here. I will see you on the next video.